Hi. So now I'll be explaining to you about one of the important again concepts, which is a matching principle concept. So as the name suggests, the matching principle concept means you need to match the expenses with the income. So how can the expenses be matched against the income? So in what sense does this say the expenses needs to be matched to the income? So matching expenses to the income means we are supposed to record only such expenses which you can attribute it to the income. So any expenditure that does not relate to the income should be carried forward to the next year. That is what it means. So for example, what? So for example, the best example is deferred revenue expenditure. Deferred revenue expenditure. In the case of deferred revenue expenditure, the best example is, so what is the, first of all, what is the meaning of deferred revenue expenditure? For the expenditure which you have met today, but because of that, the revenue you're going to accrue, you're going to earn it in future. So the example is advertisement. You spend for expenses today, and you're going to earn the revenue in the next 3 years. So let us say you spend around 10 lakhs towards advertisement, and you see there is an increase in the income by 3 lakhs each for next 3 years. This is the increase in the income. Okay. So now this advertisement of rupees 10 lakhs should not be accounted in year one, because you have an expenditure of 10 lakhs, but you have earned an income of only 3 lakhs. This 3 lakhs is increase in the revenue. This is not the whole revenue. The revenue, the normal revenue will remain as it is. This is an addition, in addition to revenue because of this spendings. Okay. So now because of this spending, I think I should revise this. I will increase it to 5 lakhs each. Okay. So because of spending 10 lakhs, I earned around 15 lakhs over the 3 years. So now, how am I going to account for this? So in year one, my advertisement expenses will be 3 lakh 33,333. That is 1/3 of 3 years. And credit bank, because you need to pay the advertiser the complete 10 lakhs, and you debit again, this is debit, again you debit deferred revenue expenditure. You have deferred revenue expenditure of 666 and 667. Okay, so the total is 10 lakhs, which you have paid already to the advertiser. So but you're going to book in year one the advertisement of only rupees 3,33,333. So that means you're going to match this expenses to the income, year one income. So this is how we're going to do it. So year two, you're going to pass an entry saying that advertisement debit, again 333,333, that is 3,33,333, to deferred revenue expenditure 3,33,333. So in year three, you're going to debit advertisement again for 3,33,334 to deferred revenue expenditure. So that's just the rounding off difference, 333,334. So this is the best example which explains the matching principle concept. That means we are booking the expenditure to the extent of income that is generated. So that is how we will do book the expenditure. So this is in consonance with the requirement of matching principle concept. So now the second example that I can give you, the best example, is your profit and loss account. That is the closing stock treatment in the profit and loss account. So in the profit and loss account, let us say your opening balance has some 100 stocks of rupees 100 each, so that's 10,000, and you have made a purchases of some 200 stocks at the rate 100, that's 20,000. Okay, so now you're going to sell 150 stocks at the rate of 200, that is 35,000. Okay, so now what you've done is you've booked an expenditure of for 300 quantity, wherein you have sold only 150 quantity. So my expenditure is not matching to my revenue. I've overbooked the expenditure, so therefore I need to reduce this expenditure. How do I reduce this? Either I can say less unsold stock of 150 quantity at the rate of 100, or otherwise that is 15,000, or otherwise I can move this on the right hand side with a positive figure, that is closing stock or unsold stock 15,000. So that means I'm removing this expenditure from the debit side, that is from the P&L account, and I'm going to move this to the balance sheet. Closing stock 15,000. So in this way, I'm going to match the expenditure that I can attribute to my sales. The rest of the expenditure, that is the stock which is not being sold during the year, so I cannot match it to my sale because this expenditure is not utilized for the current year. So therefore, I need to move this to the asset. Any expenditure that is not utilized will naturally become an asset. For this year, will naturally become an asset. So there's one more way of looking at what does an asset mean. So this is a matching principle concept. You can take the example of prepaid expenses also. Prepaid expenses or prepaid insurance. Prepaid expenses or prepaid insurance does not relate to this year, right? Because it relates to the subsequent year or subsequent months. So we are going to account this as a prepaid expenditure of insurance, so to match only the current year expenses against my sale. So this is in nutshell what do you call it as a matching principle concept. Hope this is clear, and in case you have any further queries, you can always post your question on this channel. Okay, thank you very much for watching.